All right, welcome back, everyone. We're diving into some ACCA MA mock exam questions today.
Yeah, gotta love mock exams.
Well, they're definitely thought-provoking, let's say.
Yeah, definitely. I think they're super helpful, though, right? You can really see where people get tripped up.
Definitely.
Yeah.
Yeah. It's like a sneak peek into the real exam pressure.
Yeah.
So this document, that was shared, some of this stuff is, well, it's pretty tough.
Oh, yeah, for sure. For sure.
But hey, that's what we're here for, right?
Well,
To break it down. So let's jump right into that first question.
okay, let's do it.
All about calculating probabilities with the normal distribution. Now, I know it's like statistics 101.
Yeah, right. It's the basic.
But, it's easy to get a little confused, especially when you're in that exam mode.
Oh, absolutely. Yeah. And I think one of the things that trips people up sometimes is like, you've got that Z table,
Right.
but people forget what it actually tells you.
Right,
It's
yeah.
giving you the probability between the mean and that Z score,
Right, yeah.
not above or below it.
Yeah.
So if the question asks, like, what's the probability of something being greater than this value?
Right.
You got to remember to subtract that table value from 0.5.
Oh, yeah, yeah. Easy to overlook that little detail, especially, when the clock is ticking.
Exactly. You got to understand the concept, not just like, memorize the formula.
Yeah, for sure, for sure. So the next question, actually, it builds on this a bit. It's all about, like, the properties of the normal distribution.
Okay.
There's two statements, true or false.
Right.
The first one, the total area under the standard normal distribution curve is 1.
True. That's got to be true.
True. Okay. And second, in any normal distribution, the mean and the median are the same. What do you think?
Also true. Both of those are absolutely true.
Okay, so why? Why are those true?
So the first one, that's because, under that curve, we're talking about all the possible outcomes.
Yeah.
So it's going to be equal to 1,
100%.
Okay. And then the second one, that's because the normal distribution is perfectly symmetrical.
Okay.
So the mean, the median, the mode, they're all the same point, right in the middle.
Oh, that's pretty cool.
And that applies to any normal distribution. Doesn't matter what the mean or standard deviation is.
So that symmetry, it's kind of a key thing to remember. Right?
Yeah, absolutely.
Okay, let's shift gears a bit. Question 3. This one takes us into the world of adventure travel.
Ooh, sounds fun.
Right. Horizon Travel Co., they offer these adventure packages, but, demand's uncertain.
Yeah, it's always a challenge.
So they pre-book 50 spots every week at a cost. And each package sold, it brings in a certain amount of contribution.
Okay.
We've got this probability table, shows the likelihood of different demand levels.
Right.
And we need to figure out, like, the expected profit. How do we tackle this whole uncertain demand situation?
Well, expected profit, that's super important, right? When
Yeah.
you're dealing with uncertain demand, because you can't just look at like the best case scenario. You've got to consider all the possibilities and how likely they are.
Okay.
So you basically calculate like a weighted average, the profit at each demand level,
Right.
taking into account the probability of each one happening.
So it's like you're balancing that potential profit, but also the risk.
Yeah, exactly. And don't forget, when you're calculating the profit at each level, you got to think about those fixed costs too.
Okay, yeah.
The ones that are there, regardless of how much you sell. And then, of course, the variable costs, which depend on the number of packages.
Yeah, of course, of course. All right, well, I'm ready for a new challenge. Let's move on.
Okay, what's next?
Variance analysis. I know. Some people might be groaning right now.
It can be a bit tricky.
It can be, but it's important. So question 4. It zeroes in on those fixed overhead variances.
Right.
Specifically, we're trying to figure out the budgeted machine hours. And we know there's a favorable capacity variance and an adverse volume variance. Where do we even begin with this?
Well, I think the key is to really understand like what each variance is telling you. The capacity variance, that's all about how efficiently you're using your available capacity, comparing the actual hours worked to what you budgeted.
Okay.
So a favorable variance there means you actually worked more hours than you planned.
Right.
Which is, generally a good thing.
Yeah.
Then you've got the volume variance. That focuses on your actual production, compared to the budget.
Right.
So an adverse variance there means you produced less than planned.
So both of them are looking at those budgeted hours, but in different ways, right?
Yeah, exactly. One's like, did you use your time well? And the other's like, did you make what you were supposed to?
Yeah, I like that. So a favorable variance, it's not always good, and an adverse one isn't always bad, right?
It all depends on the context.
Exactly. So how do we use these variances to actually figure out those missing budgeted machine hours?
Well, we've got a formula for that capacity variance.
Yeah, okay.
It's actual hours, budgeted hours, times the standard fixed overhead absorption rate.
Right.
And that equals your capacity variance. We know the actual hours, we know the absorption rate, and we know the variance itself. So we can plug those in and solve for the budgeted hours.
Oh, so it's a little bit of algebra.
Yeah, a little bit of math, never hurt anyone.
Well, I'm ready to move on to the next set of questions.
All right, let's do it. I think things are about to get even more interesting.
Stay tuned. We'll be back after a short break.
Okay, so time series analysis, specifically the multiplicative model. This question, it's asking us to calculate a missing seasonal variation for quarter 4. And we've got the variations for the first 3 quarters. I don't know about you, but I always found this part kind of tricky.
Yeah, the multiplicative model, it's got its own quirks. One big thing to remember is how it handles those seasonal variations.
Right, yeah. In the additive model, they're just like absolute amounts you add or subtract from the trend. But in the multiplicative model, they're ratios. You got to multiply by the trend.
Okay, yeah, I remember that. And those variations, they got to be balanced throughout the year.
Exactly,
Yeah.
yeah. So in a multiplicative model, the seasonal variations for all periods, they got to multiply to the number of periods. We're talking quarters here, so they got to multiply to 4.
So if we add up the variations for the first 3 quarters, subtract that from 4, we've got our missing variation for quarter 4. It's like a little mathematical puzzle.
That's a good way to think about it. Got to make sure all the pieces fit.
Okay, question 6, costing methods. Absorption costing versus marginal costing.
Ah, the classic debate.
It's asking, like, which variances would actually change value if a company switched between those two systems.
Okay, interesting. Well, the heart of the matter is how they handle fixed overhead costs.
Right.
Absorption costing. It absorbs those fixed overhead costs into the product cost, spreads them out over the units produced.
Right.
Marginal costing. It treats them as period costs, expenses them in the period they occur.
So that difference has got to affect some of the variances.
Oh, absolutely. Things like the sales volume margin variance and the total fixed overhead variance, they're going to be calculated differently depending on which system you're using.
It's amazing how something as simple as, like, how you categorize a cost can have such a big impact.
Right. It really changes how you view the financial performance.
All right, question 7, bottling plant. This one's about production loss.
Okay, so we're getting into some real-world stuff now.
Right. Got to calculate the standard cost of liquid input per bottle. But there's a 30% loss because of, spillage and evaporation. It's like those hidden costs in manufacturing.
Yeah, got to count for that waste.
So how do we, factor that into our calculations?
Well, think about it. That 30% loss means you need more liquid input than the final 2 liters you want in each bottle.
Okay, yeah.
Got to work backward from that 2 liters. You divide it by 1 minus the loss percentage, so 0.7 in this case.
Right.
That gives you 2.86 liters. That's your total input needed per bottle. Then just multiply that by the standard price per liter, and boom, you've got your standard cost per bottle.
So you're adjusting for that loss to make sure you're putting in enough to get what you need in the end.
Precisely. Got to be practical, right? Real world stuff.
Okay, let's talk budgets. Question 8, flexed budgets.
All right. Love a good flexed budget.
Right, so we've got these budgeted figures for fixed and variable production costs at 10,000 units.
Okay.
But actual production,
Yeah.
11,000 units. And the total production cost was $8,000. We got to calculate that total production cost variance. Why are flexed budgets so useful here?
Because they let you adjust based on those changes in activity.
Right.
You're not stuck with that original budget for 10,000 units when you actually made more. So you flex it, you keep the fixed costs the same, but you scale up those variable costs to match the actual production.
So you're basically matching the budget to reality.
Exactly. Makes
Right.
the comparison way more meaningful.
Now, question 9. This one's a good one. It's about calculating the standard contribution from the actual contribution and a bunch of variances.
Ooh, working backward. I like it.
So we're given the actual contribution and then a whole list of variances. Sales volume, sales price, fixed overhead, direct materials, direct labor, variable overhead. It's like a variance party.
It is. And we've got to use all that information and figure out what the contribution should have been if everything went according to those standard costs and selling prices.
It's like detective work almost.
Yeah. You're starting with that messy actual contribution, and then you're using the variances to untangle it, adjust for those positive and negative impacts, and what you're left with, that pure standard contribution.
And that tells you what?
Tells you where to look closer. Is it cost control, pricing, efficiency? The variances are like clues.
I love that. Okay, one more before we wrap up this section. Question 10, value analysis.
All right, value analysis. It's all about understanding what's important to the customer.
So there's this desk, 2 features. 1, the sales price, $149.
Okay.
2, it can be attached to other units to make like a bigger desk.
Interesting.
We got to classify those features according to the principles of value analysis. This seems like a really useful tool for figuring out customer perceptions and how to make a product more profitable.
It is. It's all about maximizing value without just jacking up the price. So there are 4 main aspects of value: exchange value, steam value, cost value, and use value.
Right.
That's sales price. That's exchange value. Straight up, what are they paying for it?
Okay.
But that reconfigurable feature, that's use value. It's adding functionality, flexibility. That's valuable to customers who need to, change up their workspace.
So one's about the cost, one's about the benefit.
Exactly. It's about understanding the whole value proposition.
I love that. Okay, I think we've earned a break. We'll be back with the last set of questions, and trust me, they're just as interesting. Okay, we're back, and we've got a budgeting scenario up next. Innova Manufacturing Ltd., they need to budget their maintenance costs for month 8. We've got some historical data, maintenance costs at different production levels, and they've got this rule: 1 maintenance supervisor for every 2,000 units produced. They're expecting 3,250 units in month 8. So how do we figure out that total budgeted maintenance cost?
Well, first things first, right? We got to figure out how those maintenance costs behave. Are they fixed, variable, or, a little bit of both?
Right, got to figure out that cost behavior pattern.
Exactly. So we look at the data. The total maintenance costs, they're fluctuating at those different production volumes. And those supervisor costs, they seem to be tied to production as well. So it's probably safe to say we're dealing with a mix of fixed and variable elements here.
Okay, so we got to separate those out to make a good projection, right? How do we use this data to do that?
Let's look at the cost per unit at those different levels. So at 1,500 units, they'd have 1 supervisor, right? That's $1,000. Subtract that from the total maintenance cost of $4,000, leaves you with $3,000 of variable maintenance costs. Divide that by the 1,500 units, you get a variable cost per unit of $2.
Okay, so at 1,500 units, variable cost is $2 per unit. What about at 2,500?
All right, so at 2,500, they'd need 2 supervisors. That's $2,000 in supervisor costs. Take that away from the total cost of $7,000. You're left with $5,000 in variable costs. Divide that by the 2,500 units. What do we get? $2 per unit again.
So it is consistent. That variable cost per unit, it's holding steady. So for month 8, we got to factor in those supervisor costs, right? How do we do that?
Well, we know they need 1 supervisor per 2,000 units. 3,250 units in month 8 means 2 supervisors, right? $2,000 in supervisor costs. Add that to the total variable cost, which is 3,250 units, times that $2 per unit we figured out, gives us a total budgeted maintenance cost of $8,500 for the month.
Okay, so it's like we're piecing together all these little parts to get that big picture cost. All right, last question. This one's about those direct material variances. And it's not just about the math, it's about what those variances tell us about the company's decisions.
Exactly. Variance analysis, it's like getting into the company's head a little bit, seeing what choices they made.
So Lyco, they make light bulbs. We've got some info about their direct material purchases, standard costs, and some variances that make you go, First, we got to figure out the actual price they paid per kilogram for those materials. There's a favorable price variance to consider.
All right, so they bought 500 kilograms. Standard cost is $2.25 per kilogram. That's a standard cost of $11,125 for the whole purchase. But they got a favorable price variance of $125. Sounds like they got a good deal.
So to find the actual cost, we take that standard cost, subtract the variance, leaves us with $1,000. Divide that by the 500 kilograms, boom, actual price of $2 per kilogram.
Nailed it. They saved some cash on those materials.
Next up, we need to calculate the standard quantity of materials they should have used for actual production. But there is an adverse usage variance of $45 to throw into the mix. This one's a bit tricky. The problem doesn't actually say the actual quantity used.
Ah, gotta love those little twists. Well, for this calculation, we can just assume the actual quantity used is the same as what they purchased, those 500 kilograms.
Right, makes sense.
So we can figure out how much less they should have used based on that adverse usage variance. Divide the variance, $45, by the standard cost per kilogram, $2.25, gives us 20 kilograms. That's the shortfall.
Okay, they used 20 kilograms more than they should have. So take that away from the actual quantity, we get a standard quantity of 480 kilograms. Now here's the interesting part. The problem gives us two possible reasons for these variances. Using lower quality materials or higher quality materials. What do you think? What's the story these variances are telling us?
Well, we've got a favorable price variance, but an adverse usage variance. What does that tell me? They probably went for those lower quality materials, saved some money up front, but ended up needing to use more to get the job done.
It's a trade-off, isn't it? Sometimes saving in one area can cost you in another.
Absolutely. Financial analysis, it's all about those connections. You got to see the whole web.
And that brings us to the end of our deep dive into this ACCA mock exam feedback. We've covered a lot of ground, from those basic probabilities to some pretty complex costing scenarios.
It's been a great journey. We've seen how these concepts play out in real-world situations, and hopefully we've given our listener a few tools to tackle those challenging exam questions.
Remember, it's not just about memorizing formulas. It's about understanding the why behind the numbers. What are they telling you about a company's operations, their decisions, their performance? That's the real power of financial analysis. So, to our listener, keep exploring, keep learning, and keep that curiosity alive. Thanks for joining us.